What's up, guys? I'm Des here from the Strong Family Money Show. Thanks for coming back. In this episode of Business School 101, we're going to talk about what is cash on cash return. So, when I learned about this term, it was researching investment, real estate investing. So there are a bunch of just calculations that the everyday investor must know, right? So you can quickly determine whether the property that you're going to invest in is a deal or not. Are the rents in the area good? How much money you're going to get? What's your cash flow? So they're just like back of the envelope, and there are more detailed calculations, and as the case in this formula, but there are also just back of the envelope calculations or stuff that you can do in your head. So this might not be like a general term that everyone will have to know at some point in their life, but if you're going to be investing in real estate, it's definitely something that you want to keep top of mind, right? So cash on cash return is the annual rate of return on the amount of money invested in some time period, right? So usually this calculation, for at least the form that I've used it or have seen it used in, is for like a year of time. So for the amount of money that you have invested in a property, so total cash invested is based on, compared to the annual pre-tax cash flow. So if you take off, so you have your gross scheduled rent and other expenses, right? Minus your vacancy, operating expenses, and annual mortgage payments. So all the stuff you get in, right, minus all the stuff that goes out, that's your pre-tax cash flow, right? And then you divide that by the total amount of money you invested in the property, and it's just like cash investment. It isn't like, we put in a pool and, right, this should be worth more, right? It's only the cash out of your pocket, right? So obviously, if you make all your money back in that 1 year, and the answer is basically 1, then that's not gonna happen. That's like fantasy land, right? So depending on your area, you have to research what's in your area, what a good cash on cash return is. Some markets are better at this than others. There are other reasons to invest in real estate that have nothing to do with this, but this is just one of the many things you have to take into consideration to decide whether you're going to invest in a property or not. And you definitely don't want to have it at 0, right? Or like nothing. So the higher the value, so you want to have, so the higher the value means that you have a better investment vehicle to invest in. So I have an example written down here. So let's say you have a property, 100K property, you put 20% down. And you have all these costs that you've put in, right? You put 20K down, you have 10K in renovation, you have 2% in closing costs, so that comes out to, based on the property value, $32,000. Okay, so that's your cash that you have put in to the property, and it's a multi-unit property. So let's see what this would be. 12-unit property. So let's say your cash flow on each unit, or for so we have a monthly cash flow of $200 a month after we say, even you can do this as a single property, $200 a month after we take out like debt service and vacancy and operating expenses. We have $200 of cash flow every month, right? And then for the year, because that's usually what we calculate cash on cash return for in this situation, That's $2,400 a month. So then you take your 32K, or you take your $2,400 a year for the cash flow per month, and you divide that by your 32K that you invested in the beginning. Then you do that calculation and you get 7.5% cash on cash return. Is that good? Depends, right? Depends on what your market is, right? You want to make sure that you're not overspending cash to get a small return, right? So if you got $100 cash flow per month, that's $1,200. So then you would have like a 3.75 cash on cash return, right? So that means that your investment is yielding less than if you were to get $200 cash flow, right? Another way to think about it was maybe you didn't have to do renovations, so you're going to have to invest less cash. That would bring the cash and cash return higher, right? So that it really is just you getting a feeling for how well your investment is doing over a certain time period. And the more money you invest in it, based on what the return is, will determine how well of an investment it is, right? Can you raise rents? That'll increase your cash on cash return, right? Can you, for investment, right? Can you make a lower down payment, right? That'll be less cash you put in, and you'll have a higher cash on cash return. So it really is just a rule of thumb to determine how well your investment's gonna do or is doing. And if you do it in a property you already have, you can then say, I want this cash on cash return to be higher. What can I do to do that? So anyway, cash on cash return. This is Business School 101. I'm Modesto from the Strong Family Money Show. Thanks for watching. I will talk to you guys next time.